we're going to talk about the most common time-tested ways to manage risk for long-term investors. And this is done through diversification. Diversification is spreading your money across different assets, because you don't want to place all your eggs in one basket. Because what happens if you drop the basket? All your eggs are broken. It doesn't matter how good you think a stock is, there will always be a chance that the stock could experience turbulence or, even worse, go bankrupt. For example, look what happened to Radio Shack. In 1975, it had a stock price of $11.50. And by the year 2000, it was near $100. So back then, it was an excellent investment. I mean, you would see a bunch of Radio Shacks around, and it would seem that they aren't going anywhere, but times change, and new innovations come along, and new competition comes out, like Amazon. And then by 2015, Radio Shack's stock price went all the way down to 37 cents per share, and then they went bankrupt. The point here that I'm trying to make is no matter how strong or how good you think a company is, you never want to put all your money on that one company, because anything can happen. The CEO could get caught for fraud, the company could get sued, their products become outdated, new competition could arise and take them out of business. I mean, the list could go on, and this stuff isn't something that you could see coming or have any control over. I know it may sound crazy right now to think giants like Amazon, Microsoft, Bank of America, or Netflix would ever go bankrupt, but you just never know where these companies will be in the next 20 years. I'm not saying that these companies will be bad in 20 years. I'm just saying it's impossible to know what the future is going to hold. So you don't want to be betting that the company you pick is going to perform well forever. It's very possible that if you bought a company stock price right now at this point in time, that whatever price you get it for, that will be the last time it's ever at that price again. Literally, there is no telling how a company will perform in the future with 100% certainty. There's no telling what the markets will be like in the future. Everything could come crashing down tomorrow, next week, next year, 5 years from now. No one knows. And this is why we manage risk, because you just don't really know where the price will eventually be at by the time you plan on selling. Let's say that you plan on holding for the next 10 years. Well, anything can happen within that 10 years. The company could go through some rough patches, or it could go through some spectacular runs. Price will go up, price will go down, and price will go sideways. The economy as a whole could go in the gutter. New tax laws or regulations may come out, all of which have an effect on that company you choose. And by the time that 10 years is up, who knows where the price will be? We can't foresee the future. So one of the best ways to manage risk from the unknown is to simply diversify. And one of the methods to diversify is to allocate funds across different asset classes and market caps. Now, if you remember, market capitalization is associated with different risk and reward levels. Usually large cap stocks have less risk, but less reward, while small cap stocks have high risk, but high reward. So by having a mix of large and small cap stocks, we can have exposure to everything that will kind of balance the risk and reward levels out. So anything that performs poorly will be offset by anything that performs well. By having a diversified portfolio, you're going to yield greater returns with the least amount of risk compared to a non-diversified portfolio. So when we are creating a diversified portfolio, we can allocate a certain percentage of our funds to any asset class to help meet the goals we are trying to achieve. Now, in no way are these recommended allocations. These are just illustrations to help me explain what I'm talking about. So here I have 3 portfolio asset allocations, and I've broken them down into 3 different categories: aggressive, moderate, and conservative. Now here on the aggressive side, we're going to have more equities than fixed income. Because remember, equities have high risk and high reward. So do REITs. So the majority of this portfolio is high risk, high reward. Large cap, small cap. You can have international, so we want to diversify it outside the United States, just in case if the United States goes through some rough patches, there's going to be some other countries or other companies outside the United States that still thrive. So that's going to balance out the risk and reward, all right? But look how small the fixed income is compared to all the high risk, high reward, all right? So this may be something for someone that is investing for a really long time, 20, 30, 40 years. If you're young, this might be an appropriate asset allocation. But if you get kind of older, then you want to protect your money. You don't want to be as aggressive, so you might move into a moderate portfolio allocation. And as you see, the fixed income increases. Now we have more bonds and more cash as compared to the high risk, high reward. And then if you get really conservative, now you have a large amount of fixed income, bonds, cash, and then just a very small portion of equities. Now, again, these are not recommended allocations. You need to seek a professional licensed financial advisor to help you design a portfolio. This is just an illustration to show you how portfolios are designed based on your goals, your timeline, and your risk tolerance. Now, in order to properly be diversified, you have to own many stocks. All right, we can't just pick one investment in each asset class and say that we're diversified. We are still relying on that one company or investment to do well. But in order to have a lot of investments, you have to have a lot of money because, as you can see, some of these companies are priced in the hundreds of dollars. So it could be really difficult for a small investor to be able to properly diversify. And one way to overcome this is to invest in ETFs. Now, again, this is not a recommended product to invest in. I'm just using this as an example, just to show you that there are ways to have exposure to many stocks. ETFs are one of them. Some brokers allow you to buy fractional shares of a company. All right, but we're going to use ETFs here as an example. And what ETF stands for is an exchange traded fund. And basically, it's a collection of securities that trades much like a single stock. So think of an ETF as a mini portfolio. If we wanted to diversify with large cap stocks, instead of just buying one share of a large cap stock, we can purchase a large cap focused ETF that has exposure to many large cap stocks. So here I've pulled up a large cap focus ETF. It's managed by Charles Schwab, and in no way, again, I'm recommending this ETF. I'm just using this as an example, but I just wanted to show you how this is broken down. So down here you can see all the holdings by the different sector that this one ETF has exposure to. 24.7% of this ETF has stocks related to information technology. 15.4% is healthcare, 15% is financials. And down here, you can see all the stocks that this ETF has exposure to. So 3.7% of this ETF is Microsoft. 3.19% is Apple. And some of these companies are priced well in the hundreds of dollars. But up here, as you can see, the price of this ETF is $70.05. So it's much cheaper to own an ETF that has exposure to all these higher price companies. And this trades just like a stock, right? You can come over here, hit the trade button, you'll type in the amount of shares that you want, you click the buy button, and you got it. And the price of these move up and down just like a normal stock. So this makes it easier for someone with limited funds to have exposure to all these big companies, but not have that high price tag associated with it. Now, there are thousands of ETFs to choose from, and they all have different pros and cons, different risk to reward, different performance ratings, and they all have different schemes associated with them. So some of these schemes could be ETFs focused on companies' revenue. You can have an ETF that's focused on companies providing high dividends. You can have an ETF that's focused on market cap. You can have an ETF that's focused on fixed income. One's focused on the fundamentals of a company. Ones that are focused on momentum. You can have ones that are focused on technical analysis. I mean, there's so many to choose from, which can make ETF investing a little overwhelming. So this is why, again, you need to seek a professional licensed financial advisor to kind of help you pick the best ETFs out of the thousands to choose from to meet your specific needs. Now, holding ETFs, or basically diversifying in general, isn't going to be an exciting way to invest because you're not going to make 10 or 20% returns in a day or a week if you hold many companies. If you were holding a single stock company, that's possible. But if you're trying to reduce the risk, you're mainly just going to see steady growth over time. So what ETFs do is basically try to perform as well as the overall market. So here I've pulled up a chart of this ETF that we just looked at, the Schwab US Broad Market ETF, the large cap blend. And I've compared the performance of this ETF to the S&P 500, right? So this line right here in orange is the S&P 500, and this blue is this ETF. And as you can see, they are tracked pretty closely, and that's basically what you want. And I know it's not an exciting way to invest, but investing long-term really shouldn't be exciting. What's exciting is gambling, and that's exactly what we are not doing here. We are trying to manage our risk so we can get the most returns with the least amount of risk possible. Now, once you have a fully diversified portfolio designed to fit your specific needs, you can manage your risk even further by dollar cost averaging. Dollar cost averaging is where you're going to invest the same dollar amount on regular intervals, regardless of what the current asset price is. So this would be like putting in a certain dollar amount into your investments every time you get a paycheck. And if you have a 401k, this is exactly what you are doing. All right. So you're putting a set amount of money into an investment every time you get paid in order to grow your nest egg for retirement. All right. So in this example, we're going to be putting in money at the end of each month. So at the end of the month, we're going to be putting in $100. No matter what the price is, we're going to add $100. And as you can see, the price is different each month. So no matter if it's going up or going down, we are always putting in $100 at the end of the month. But since the price is always changing from month to month, so will the number of shares that we'll be able to buy at the end of the month. If the price is high at the end of the month, we won't be able to buy as many shares as if the price was low at the end of the month. So back here in April, if the price is $20, out of our $100 investment, we're only able to buy 5 shares. If the next month the price is at $25, we're only able to buy 4 shares with our $100. So after 8 months of adding $100 at the end of each month, this is how it's going to play out. So if we calculated the average share price over the last 8 months of what this asset was, it would come out to $16.85. All we do is add up all the prices per share, divide it by the total number of months, which is 8. Average share price, $16.85. But if we calculated our average cost per share, all right, it would actually come out much lower. We take the total number of investments, we divide it by the total number of shares that we have accumulated, and that will give us $12.69. So as you can see, the average cost that we paid per share is much lower than the actual average per share that this asset has made. So as we've learned, the reason we diversify is to reduce our risk to any one asset. And holding a mixture of assets will balance out our risk and return potential, because any asset that performs well will offset any asset that performs poorly. And these different assets perform differently compared to each other every year. So I wanted to pull this up to show you. This is a publication called Guide to the Markets. It's released by JP Morgan. You can go to their website. They got a bunch of cool stuff on there if you're interested. But this is the history of all the asset class returns over the past 14 years. So 2004 to 2018 is going to show what each asset has returned year by year. So in 2004, REITs returned 31.6%, while large caps returned 10.9%. In 2005, emerging markets, so that's stocks outside the United States, they returned 34.5%, while large cap stocks inside the United States only gained 4.9%. All right, sometimes you have years where small cap stocks outperform large cap stocks, and you have some years where large cap stocks outperform small cap stocks. Sometimes you have years where cash outperforms everything, right? So you see year by year, all this changes, and there's no way to predict what's going to be on the top list of the current year. So that's why it's important to diversify so you can kind of strike a balance. And this is what this line here represents. If you had a diversified portfolio, you would kind of somewhere be in the middle here. So you're still going to have the best chance for high returns, but also have low risk. So knowing that different asset classes outperform others and they change every year, we need to make sure that our defined asset allocation doesn't change to something that we don't want it to. So let's say that this is the asset allocation that we want. We want 40% of our funds to go to large cap, 20% go to small cap, 20% go to REITs, 13% go to international, 5% bonds, and 2% cash. But let's say that one year, small caps outperform everything. They do really well, and then large caps don't do so good. Now, since small caps did well and large caps did poorly, that's going to change our portfolio allocation. So now we may have an asset allocation of 40% small caps and 20% large caps. And that's not something that we want. We want 20% small caps and 40% large caps. So when something like this happens, this is when we need to rebalance our portfolio to get us back to our defined asset allocation. So what we're going to do is sell 20% of our small cap positions and then funnel it into the large cap positions to bring us back to our defined asset allocation. Now, why rebalancing is so important is not only you are keeping your exposure to certain assets under control, but you are forcing the practice of selling high and buying low. Since small caps outperformed that year, you sell when they are high. You are taking the gains that you made in small caps and putting it into large caps, which are low. So the general rule of thumb is whenever your defined asset allocation gets about 5% outside the defined range, you need to rebalance your portfolio. Compounding interest is the driving force behind long-term investing. It's going to have a snowball effect on your investments the longer you contribute to them. Because when you contribute on a regular basis, you're going to receive interest not only on your original investments, but you'll receive dividends and capital appreciation that will also accumulate, so your money grows in a snowball-like effect fashion over time. So the sooner you can start investing, the more money you're going to have, which is why if you're young, maybe if you were in your teens or your 20s, right now is the best opportunity for you to start investing, and let me show you why. Let's say that you're young, you're 20 years old, and you want to contribute $100 every single month. All right, so you're 20 years old, age of first investment, and you want to contribute $100 every single month. So at the end of the year, you're going to contribute an annual amount of $1,200, right? Now, let's say you contribute $100 every single month for the next 10 years. And then you stop. So the age of your last investment will be 30 years old. So you're investing $100 for the next 10 years, you're going to stop. You've contributed $12,000 during this 10-year time span. But you're not going to touch that investment. You're not going to add to it. You're not going to subtract to it. You're just going to leave it alone, and you're going to let it grow. And you're not going to touch it until you retire. So normal retirement age is 65 years old, so you're going to let that grow for the next 35 years. And then once you reach 65, that's when you're going to touch it. So we're going to type in 35 years. Now, during this time, during the start of your first investment, all the way to where you need to touch the money, that's going to be 45 years, you're going to get an annual return of 10%. Now, 10% has been the average return of the overall market over the past 100 years. Now, that doesn't guarantee future returns, but over the past 100 years, that's usually what the market averages out to be. Sometimes you'll get higher than 10%, sometimes you'll get lower than 10%. But over the average, over a long time span, we'll just call it 10%. All right, so let's go over what we're doing again here. You're going to start investing at 20 years old. You're going to add $100 every month for the next 10 years, and then you're going to stop adding. And then you're going to let that money grow until you turn 65, and then you're going to cash out. So let's see what that $12,000 investment between age 20 and 30 produces. So when you turn 65, you're going to have $687,417. Off of that original $12,000 investment that you did from age 20 to 30. Now remember, you did 20 to 30 and then you stopped adding. All right? And then by the time you're 65, you're going to have this much. Now let me show you why starting as soon as possible is so important. Let's go the other direction. All right? Let's say that you started investing at age 30. All right? And you did $100 until you're 65 years old. So $100 every single month until you're 65 years old. All right, we'll change this to 0 because that's when we're going to take out our money. All right, so $100 from age 30 to age 65. That's 35 years of making $100 investments every single month. Over that 35-year span of doing that, you would have contributed $42,000, okay? Now, we're still going to do the same annual percentage return. Let's see how much money you would have doing it this way. You think you'll have more? Well, by the time that you are 65, you're only going to have $394,000. So that is the power of compounding interest because it's the time that matters. The longer you gain that 10% every year, that 10% is going to add to the previous 10%. And year after year after year, you're going to add 10%, add 10%, add 10%. The longer you go, the more money you're going to have. So as you can see, the person that did $100 every month from age 20 to 30 is going to have more money than someone that did $100 every month from age 30 to 65. So start as soon as possible, because you don't have to contribute as much and you're going to have more money in the long run. All right, so now that we know how to manage our risk through diversification and that we can take advantage of the perks from dollar cost averaging, rebalancing, and compounding interest, and we know that the longer we invest, the more money we will have, hopefully this will get you to realize that you need to ignore the media and what the market is doing on a day-to-day basis. The overall market will go up and it will go down. It will have great periods and it will have really scary bad periods. It's just part of the normal market cycle. But given enough time, no matter how bad things seem or how bad they get, the market will always find itself back to record-breaking highs. The reason for this is that people will never stop innovating. People will never stop striving to make a better tomorrow. Humans have been doing it ever since the human race began. When things get bad or disasters happen, we always fix it and make things good again. If there's a certain aspect of life that makes things difficult, someone steps up and fixes that problem with some new idea or invention. And that's basically what you are investing in when you invest in the market. Humans to keep doing what they've been doing since forever and will continue to do forever. So when the overall market goes down and is taking a beating, don't freak out. If you are diversified properly with the right asset allocation fit for your investing time horizon, use the opportunity to buy more. What a lot of novice investors do is whenever a major market sell-off happens, they panic and they lose sight of their long-term goals. So when it's selling off, they sell all their positions and then move to cash, and then only buy back in once there's signs of recovery. But what happens oftentimes is they mistime the market. So they sell their positions too late, and then they buy back their positions too late, causing them to sell low and buy high, which makes them miss all this opportunity for growth. And when you factor in compounding interest, all the dividends you'd be receiving, and not to mention the more shares you'll be able to buy if you're taking advantage of dollar cost averaging, that amount that you've missed out on right here could equate to a lot of money down the road. So just leave your long-term investments alone and stick to the original plan. As long as you are properly diversified with the appropriate asset allocation, you've got nothing to worry about. The only time you should be touching your long-term portfolio is to rebalance it and adjust your asset allocation once you get closer to the end of your investing timeline. Now, if you aren't quite sure how to design a portfolio that's fit around your specific needs, or you just want the most simple and hands-off way to invest, there are different options to invest that make this very simple. Literally, all you are responsible for is adding money into your investment account, and these options take care of the rest. So the first option is contributing to a target date fund. A target date fund is a portfolio managed by professional advisors that allocate between different asset classes to be appropriate for someone with the intent to retire or cash out their money by the year that the target date represents. So here I've pulled up a target date fund aimed for someone to retire by the year 2055. So if you were born in the early 1990s, this would be something you can invest in so you can retire around the age of 65. So notice how this portfolio is allocated. 88% of this portfolio is equities, and only about 10% is bonds and cash. This would be considered an aggressive type portfolio because of the large amount of equities compared to fixed income. But that allocation is okay to be aggressive because at the time of this recording, we are about 35 years until the end of this target date. And that's a long time away. Even if the economy crashes and the stock market loses 50% of its value in the next few years, 35 years is enough time for things to recover. So having a large exposure to equities is going to give us that potential for growth over time. Even though the risk with equities is high, the longer you invest with them, the less risk you're going to have because equities tend to grow over time. Let's look at another one. Here's a target date fund for someone who may be wanting to retire at the year 2030. Now, this recording is done in 2019. So this is an asset allocation designed to cash out only 11 years away. And notice the difference in asset allocation. 67% is equities, and then you have about 31% of fixed income. So this is a bit more conservative because we are getting closer to the date that someone is wanting to cash out around. So the shorter time frame that you have when you need your money, the more conservative you need to be because you have more risk from short-term market fluctuations. So as you hold these target date funds, the closer you get to the target date, these asset allocations are going to change. And you don't have to do anything. The fund managers that run these target date funds, which in this case is Vanguard, they're going to do all the rebalancing and reallocating for you. So literally all you have to do is whenever you get paid, you just buy shares of this target date fund. Now, target date funds are nice because it's a one fund approach. Unlike a portfolio where you hold many different assets, doing it this way can be less of a headache. Now, I believe there is a target date fund set for every 5 years. So if you are considering a target date fund to invest in, pick the one that is closest to the year that you hit retirement age, which is around 65 years old. Another simple option is using a robo-advisor. Robo-advisors provide digital financial advice based on mathematical rules or algorithms. So what the robo-advisor is going to do is give you a survey for you to answer questions so it can kind of get a feel of what your goals are, what your knowledge is of the markets, what your risk tolerance is. And it's going to ask about your current financial situation, and it's going to calculate all that together and then design an asset allocation based on the answers you've provided. So all you have to do is fund the account, and the robo-advisor takes care of the rest. It's going to rebalance your portfolio automatically and adjust things as you get closer to the time you will be needing to cash out. Now, if you don't like letting technology do all the work and you just rather have an actual human to speak to and manage your money, a certified financial advisor can be that solution. You can find a financial advisor locally, or if you use a reputable broker, they should have financial advisors you can speak to as well. I personally like using financial advisors because it keeps me in check from me doing something irrational. A financial advisor is like having a firewall between me and any financial decision I make. If I'm thinking of pulling out my long-term investments based on some news article I read, well, I'd have to go through my financial advisor to do so. And he or she may say, whoa, wait a minute, you may not want to do that. But if you want to move your investments around, there could be a better way. So that's why I'm all for a personal financial advisor. Plus, I like having a personal financial advisor around to help me with other money ventures I'm involved in, such as business startups, real estate, or maybe some sort of tax strategy I can implement that I'm not aware of. And I know what you're probably thinking, why would I pay a financial advisor when I can just do this myself? I can be disciplined to do things the right way. Why would I pay the charge? Because usually they charge around 1% a year to manage your money. But this is why I think at least having a meeting with a financial advisor is really important. Because for someone that doesn't have any financial background or doesn't completely understand the ins and outs of certain financial instruments or tax laws, you aren't going to know what to look up online. You may stumble across a couple good ideas, but there is just so much information out there that it's going to be hard to sort through everything and then get a good picture of the best way to go about things that's tailored to your specific personal situation. All right, so that is risk management for long-term investing. I hope you all learned something. I want to thank you so much for watching.